Credit access for Nigerians is the subject of our discussion today, more specifically consumer lending. As of August 2024, consumer lending in Nigeria was estimated at about 2.99 trillion, and this figure, despite making up less than 10% of our GDP, was our highest since 2020. Welcome, this is Economy and Market on BusinessDay TV, where we bring you a comprehensive breakdown of activities in the economy that affect the financial space. I'm your host, David Olujimi. We have quite a show on our hands today. We'll get some perspective on the tariff increase which happened yesterday. But before then, we'll talk about consumer lending. When I say consumer lending, the easiest term that can convey that context to an average Nigerian is something we call loan apps. Over the past 5 years, we've seen a rise in loan apps, and also with the rise in loan apps, we saw a surge in anti-consumer practices. As some of these platforms try to get their monies back, we saw quite a lot. That brought the Federal Competition and Consumer Protection Commission into the limelight over recently. It's become quite of special interest to us today because we're trying to analyze the impact of the existence or absence, basically the existence or the absence of consumer lending services to Nigeria on the country's economy. According to the IMF, Nigeria is one of the countries without data on consumer lending to GDP ratio. Why? Because that industry was almost null and void some years ago. In the US, the consumer lending to GDP ratio is about 73%. In Canada, is about 103%. In the UK, 78%. South Africa, 33%. And in India, 39%. But the question, it becomes the question, why can't Nigerians access credit services? The time we have on this show wouldn't avail us to do justice to this subject matter, but we'll try. On the show this morning, we have Anieka Joseph, a leading public policy enthusiast and a consultant to some of the world's leading multilateral development organizations. Good morning, Mr. Anieka. Thank you for joining us this morning.
Good morning, and I'm glad to be here. Thank you for having me.
So, first of all, based on your understanding, why is credit difficult to access for the average Nigerians? What are some of the factors that limit this access?
Good question, David, and thanks again for having me here. Credit is an interesting subject matter, and for us as industry players and users of credit, there are a number of things, but I would like to take an interesting perspective on this. There is a character component of every society that affects credit beyond the technical and intellectual issues around it. So let's take the idea that people say what they mean and mean what they say. That's one. Two, are there social structures that hold people accountable? Are there legal structures that hold people accountable? And before we begin to even talk about some of the, for lack of political structures, economic structures that can drive credit, it's important that we recognize that there are social capital structures that we need to account for in the subject matter of credit. That's on one hand. On the other hand, access to capital is something that has bedeviled a section of Africa called Sub-Saharan Africa. So because access to capital is a big deal, meaning that capital is relatively scarce, what you will find is that the risk appetite of people who are custodians or managers of capital is such that they must guarantee returns on those capital.
Okay.
What happens then is that they pay attention to certain specific industries that have the least risk and highest reward, whether it helps to engineer the economy or not. I just wanted to give those two so that we can proceed from there. Thank you.
Okay. Then what are some of the factors that limit access to capital, to credit basically, for the average Nigerians? You spoke about legal structures, you spoke about legal components, the character component, and some of those things. But for Nigeria, let's bring it to the context of Nigeria. What are some of these factors that are limiting access?
Well, one of the first things I mentioned was just relative cash scarcity. Okay. Another thing is, who are you competing with for cash? You know, what is the ecosystem for competing for cash?
Okay.
If I, for instance, who work in construction, I own a construction company and I get a contract with government, walk into a bank, am I likely to get a contract compared to someone who is into trading? So that competition mix is something that we need to account for. Secondly, the idea that we collateralize payment is something that also affects access to capital. If you do not have something that you can put down of value that lenders can hold on to in case you default, it makes it difficult. And in your introduction, you did allude to loan sharks and people who have low risk appetite, but that low risk appetite is compensated for by their relentless approach to recovering money, and they have built that mechanism within because of the entry barrier that they have deliberately reduced. So access to capital, competitive environment within which that exists. And then, of course, like I mentioned earlier, the social, cultural, and legal framework that exists that facilitate the exchange of that value. These are some of the things that happen. Another thing that we have to pay attention to is just business education within the country.
Yeah.
Not many people understand, for instance, the factors of production and how they can access it formally or informally. And education in this area is going to help so that we can get more people access to credit and they can be more economically active and we can have a positive feedback effect on the economy.
Thank you. So I want to ask, in your journeys, because I know that you've been around for a while, you've been to some countries due to your work with these multilateral agencies. Is it the same scenario everywhere across Africa, or this scenario is just particular to Nigeria, especially in sub-Saharan Africa?
Well, the last three letters of the alphabet, or the last three words, sub-Saharan Africa, is where we'll go start from.
Okay.
Once you go on, you draw the line on the African continent of the Sahara Desert. Every country under the Sahara is considered sub-Saharan Africa. And although that is an umbrella body that describes a group of nations that are considered low-income countries, there are certain subtle changes that you can observe in the countries across the continent that are considered sub-Saharan Africa. So if you look at, for instance, certain countries in East Africa where some level of leisure and tourism occurs, and there's some manufacturing at some level, the issue is not as exacerbated as it is in, for instance, Western Africa, where the population versus the economic activity ratio, accounts for a staggering number of people that are living below the poverty line, estimated to be about 103 million in a country like Nigeria. And then you go to the Southern African side of the continent that is considered, can call them middle income earning, certain countries like South Africa, Botswana, maybe Namibia. The concerns may not be the same. So to clearly unpack this, you would find that in certain countries like South Africa, Botswana, etc., credit may be easier to access because relative to other countries within the continent, these guys have a level of structure within the economy. The way they earn, is more within the formal sector, and they can get more access to credit so that they can do more investment that drives the economy. If you go to the eastern side of the country, so countries like Uganda and Kenya and maybe even Tanzania, the circumstances are not as dire as, for instance, Central Africa or West Africa, where a marginal number of the population is within the formal sector and can gain access to credit.
Okay, so now the question I want to ask.
Thank you, David.
Yeah, the question I want to ask is about increased access. A school of thought will say maybe increasing. So I would give an example. Last year in 2024, the CBN dropped the loan to deposit ratio for banks from, I think it was about 58%. They dropped it to 50%, meaning that banks were required to give out less of their liquid capital as loans. So they said it was part of the tightening it was one of the tightening decisions that they made for inflation. So is increased access to credit, is it likely to help our economy, or is it something that would trigger more inflationary pressures? I hope you got that question.
Yes, that's a wonderful question. And one has to first of all admit that the step that was taken by the Apex Bank, the CBN, to mop up liquidity within the system was a logical one. If you are dealing with inflation, it only makes sense to mop up excess liquidity. In any case, but when you do a deep dive into loan performance in the country, it only made sense that the percentage of loans that are likely to default, if you do a calculation of what that might be in value, you might as well also pull that back into the banking system. So yes, if you're battling inflation, you will have to find a way to reduce liquidity. And it becomes a delicate task and almost impossible when you're also trying to stimulate the economy at the same time. So you now have to be targeted in your approach to say what sectors of the economy do we want to target that can lift the most people out of multidimensional poverty and create a micro economy that we can now strengthen as we walk out of inflation. It is that delicate balance that the eggheads at the CBN and other regulatory organizations have to pay attention to. Thank you.
Okay. So now, last year also, we saw the government create the Nigerian Consumer Credit Corporation, or in shorter form, or the acronym is Credit Corp, a consumer lending agency. They said they were trying to expand credit access for Nigerians up to 50%. The solution is in another government agency, or we need some policy changes, some sit downs with policymakers and mapping out a better framework. Is this government agency the solution to increasing credit access for Nigerians?
Well, you have to excuse the government for thinking like this. The credit sector, most people would say, is largely unregulated. And a body like this is supposed to bring some order and bring semblance of regulation into that sector. Is that body itself going to stimulate the economy? The simple answer is no, but the nuanced answer is that they can take specific steps so that innovators within the space of finance can take advantage of opportunities that have been created. And now there is a body that they can go to check and test a certain hypothesis or theory of change, so that they have their permission to try this out, and the regulatory body and the business work hand in hand to learn in this innovative space, and then they are protected from certain shocks, and the roads are cleared so that even more advancements can be made in that area. So I think that there's got to be a deliberate attempt to pay attention, to hold hands with innovators, to hold hands. Innovators collaborate strongly with regulators to seize opportunities that they may not fully understand, and as they take on those opportunities, understanding will improve. A famous mathematician said that there's no idea that has been analytically proven in advance. So in a continent where we have to innovate to make the right steps in the right direction, it's important that we're willing to take risk, and our government is nimble and agile enough to allow the people who are taking the risk to take advantage of the opportunities out there. Thank you, David.
Yes, sir. Fine. One question I have on this issue is about So one time when you look at the books of our banks, you look at their financial statements. Let me not mention any bank.
Sure.
They always make claim to periods of severe non-performing loans. I think the period of the banking collapse, that was between 2008 2009, where there was like severe decline in there was a lot of appreciation in non-performing loans. This particular period has guided the direction of Nigerian banks basically to restrict consumer lending services. So for example, one bank, they had over 70% of their deposits coming in from consumers, these final consumers, not institutional consumer, not institutional customers, nor any of the big boys. Basically, consumers, regular consumers. But they had about 9% of their lending, no, 8% of their lending going to these same consumers. So many of them claim that there are no frameworks to prevent non-performing loans and stuff like that. But MTN started a lending service some years ago, and since they started this lending service, data has shown that this lending service has been one of their most profitable arms when it comes to, at least I think last year they made quite a bit of profit. Also, there is another bank that created its own lending service, consumer lending service. This lending service has consistently posted profit. Is this claim not overflowed? Don't you think it's an overflowed claim that I think in my own opinion, I think society has evolved. There's been a lot of changes. KYC measures have come up for banks to now be able to reclaim some of their loans, or what do you think?
Well, David, again, that is a complicated question, but you have to think about it in terms of what you put in versus what you get out.
Okay.
When you consider the effort it takes to manage let's use hypothetical numbers. So I think you used an example that 70% of liquidity within the bank comes from individuals.
Yeah.
And only 9% of the loans go there. If you use absolute numbers to measure this, it's easier for a bank to manage one institutional client that has significant liquidity than to manage 20, 30, 40, thousands of people or tens of thousands of people. And that value or the volume is about 9%. So when you look at the input cost in terms of personnel, opportunity cost in terms of other things you could be doing, rather than chasing one debtor, you would find that it's important that we unpack our banking system. We need to put more responsibility on microfinance banks. We need to create spaces where microcredit and micro lending is doing what it ought to do, so that big commercial banks can take care of big ticket items. And if we can restructure our services in that way. So for instance, at the local government level, especially now that we're talking autonomy, why can't we have microfinance banks working that area? And then at the level of the state government, we have commercial banks, and we now have regional banks and development banks. If we bring that level of specialization, what we will find is that people are doing what they are equipped to do, what they are designed to do, and what they have the capacity to deliver value on.
Thank you for that. Thank you. That was quite an insightful answer. But before we round up, let me make a quick switch and talk about the tariff increase. So yesterday, some people say we saw a tariff increase, but apparently upon review of the situation, we saw that MTN was just testing the waters with one of their data plans. The question now is a tariff increase, is this the right time for a tariff increase? Then if not, when is probably the right time?
Fantastic question. And I'll go back to the factors of production to respond to this.
Okay.
If you're going to do a business, you are going to make upfront investments in people, infrastructure, systems and processes. This takes investment. Now, if any of those factors of production change in price, it means that your input cost at the bottom line has changed.
Yes.
And the assumptions are made can no more hold. What may have an ability to take that shock it does not help the business climate when the bottom lighting a battle with one hand tied behind you. And it is that sensitivity that we must bring to the business climate. And if you bring that example into a petty trader, so for instance, a barber shop that probably spent 500 naira per liter on petrol now spends 1,000 naira per liter on petrol, and you ask him not to increase the cost of his haircut, it will be unfair, isn't it? Yes. So we have to take a look at these things from the fundamentals and say, if this has changed fundamentally, and government has to take into account that these were investments that were made with certain assumptions, and if those assumptions have changed, they need to be able to allow people to adjust and respond accordingly. Fortunately, in our setting, the telecom sector have had weeks and weeks and weeks of consultation with government, and I know that the reports indicated that some concession will be given, but not what they have asked for in particular. So I think that it makes sense for them to respond to the changes. And the expectation is that in responding, there's a level of sensitivity and government can meet business halfway. Thank you very much.
Thank you so much, Mr. Anyekan. Such an insightful conversation we had with you. Thank you for joining us.
It's a pleasure, David. Please take care.
So to our audience, thank you for joining us one more time. This is Economy and Market on BusinessDay Television. We see you on Friday. I remain David Olujimi. Good morning.